Hello, bosses. Welcome back to Boss Economic World. I'm your host, dissecting the money game so you don't become the liquidity for the big sharks. Today is November 25th, 2025. And if you've been watching the Forex boards, you're probably feeling a little seasick. The Japanese yen is currently trading at 156.67 against the US dollar. If you are a tourist in Tokyo right now, you are living like a king, eating Wagyu beef for breakfast. But if you are a Japanese energy importer, or holding Japanese assets, you are sweating bullets. Everyone is screaming, the yen is dead. Long live the king dollar. But, hold your horses. Or should I say, hold your carry trades. Because while the market is partying on the grave of the yen, the smartest guys in the room, I'm talking about the strategists over at Morgan Stanley, just dropped a note that sounds like a bomb going off in a library. They are saying the yen is about to rip the face off the bears. We are talking a 10% appreciation in the coming months. Today, we are going to tear apart this report, analyze the messy politics of Prime Minister Sanai Takaichi, look at the Fed's frantic maneuvering, and find the truth hidden behind the noise. Is this the buying opportunity of the decade, or a trap? Let's get into it. First, let's look at the crime scene. Why is the yen at 156.67? It's simple physics. Or rather, simple greed. For the last 2 years, we've been playing the same game. Interest rates in the US have been high. Interest rates in Japan have been, well, non-existent. When you can get a fat 4% or 5% yield parking your money in US treasuries, why would you hold yen at near zero? You wouldn't. You sell yen, you buy dollars. This is the carry trade. It's the favorite pastime of Wall Street. It's free money, until it isn't. But recently, there's a new villain in the narrative. Her name is Prime Minister Sanai Takaichi. Since taking office, Takaichi-san has been preaching the gospel of spending. She wants fiscal stimulus. She wants to pump money into the economy to keep the growth engine running. The market hears spending, and they think, oh great, more debt. More money printing. Japan is going to debase the currency to pay for bridges to nowhere. So, we have a double whammy. 1. Interest rate gap, the US pays you to hold dollars. 2. Fiscal fear, the Japanese government looks like it wants to spend like a drunken sailor. Result? The yen collapses. It has slumped 5.6% just this quarter alone. It is the worst performer in the G10. It's the ugly duckling of global finance. But here is where the story gets interesting. Because the market, as it often does, might be looking in the rearview mirror. Now, let's look at this note from Morgan Stanley that hit the desks on Sunday. Strategists led by Matthew Hornbach are making a call that goes against the herd. They are forecasting the dollar-yen pair to crash from 157 down to 140 by the first quarter of 2026. 140, that is a massive move. That is a move that wipes out leverage. That is a move that makes hedge fund managers cry in their Lamborghinis. Why? What do they see that the market doesn't? Reason number 1, the US engine is sputtering. We've been talking about the soft landing for the US economy for 2 years. But looking at the data coming out of Washington this November, the landing gear is stuck. The signs of a US economic slowdown are growing like mold in a damp basement. Morgan Stanley believes the Federal Reserve is about to get desperate. They see back-to-back rate cuts coming from the Fed. Here is the logic, bosses, and pay attention because this is the core mechanism. The value of the dollar against the yen is largely determined by the yield spread, the difference between US bond yields and Japanese bond yields. Right now, US yields are high. The spread is wide. The dollar is strong. But if the US economy slows down, the Fed cuts rates. US yields crash. The spread narrows. Suddenly, holding the dollar isn't so attractive anymore. The fair value of the pair drops. Morgan Stanley says the current price is detached from fair value. In plain English? The price is wrong. The rubber band has been stretched too far, and it's about to snap back. Now, let's address the elephant in the room, Japanese politics. The market is selling yen because they are terrified of PM Takaichi's spending plans. But Morgan Stanley says, relax. You are overreacting. They wrote, and I quote, Japanese fiscal policy settings meanwhile are not especially expansionary. This is the truth segment of our show. The market trades on vibes. It trades on headlines. Takaichi says stimulus, and the algorithms sell yen. But the reality is that the actual money hitting the street isn't enough to destroy the currency. The fear is greater than the danger. When the market realizes that Japan isn't actually going to hyperinflate its way out of debt, that fear premium will evaporate. And when that happens alongside falling US rates? Boom. The yen strengthens. We cannot talk about the yen without talking about the angry people in the Ministry of Finance. Finance Minister Satsuki Katayama. She has been on TV almost every day recently. She looks at the camera, furrows her brow, and says, "We are concerned. We are watching. Intervention is an option." Growth Minister Minoru Kiuchi chimed in earlier this Tuesday, saying they are watching speculative activity with a high sense of urgency. Bosses, let me translate high sense of urgency for you. It means, please stop selling our currency, pretty please, or we might actually have to do something. So far, Katayama's words have had the impact of a water pistol on a forest fire. The market doesn't believe her. Why? Because talk is cheap. Unless the Bank of Japan, BOJ, actually raises rates, or the Ministry of Finance dumps billions of dollars into the market, the traders will keep pushing. However, if the yen hits 158 or 160, the risk of a violent intervention skyrockets. And if that intervention happens at the same time the US data starts to look bad? That is the catalyst. That is the match in the powder keg. So, Morgan Stanley sees the yen ripping to 140 by Q1 2026. But here is the kicker, they don't think it stays there. They expect the pair to rebound to 147 by the end of 2026. Why the roller coaster? Because they believe the US slowdown is temporary. By the second half of 2026, the US economy recovers. The engine starts again. Demand for the carry trade revives. The yen weakens again. It's a cycle, bosses. The economy breathes in, the economy breathes out. Phase 1, now, Q1 2026 US slows, Fed cuts yen rallies to 140. Phase 2, Q2 2026 end of 2026 US recovers, yield stabilized yen falls to 147. If you are a trader, this is a roadmap. If you are a long-term investor, this is a warning not to get married to a position. Okay, for my finance professionals and bond geeks in the audience, let's get technical for a minute. If you don't know what a yield curve is, just imagine a banana. Sometimes it's curved, sometimes it's straight. You want to buy the banana before it turns brown. Morgan Stanley isn't just telling you to buy yen. They are telling you to look at Japanese government bonds, JGBs. They expect the Japan sovereign yield curve to bull steepen in Q1 2026. Let's decode that. A bull steepener usually happens when short-term interest rates fall faster than long-term rates, or expectations of future rate hikes collapse. They are recommending long positions in 10-year JGBs, betting bond prices go up, yields go down. Short positions in 30-year JGB asset swap spreads. Why? Because the US slowdown is a global contagion. If the US slows, Japan slows. If Japan slows, domestic inflation pressure drops. That means the Bank of Japan doesn't have to hike rates aggressively. That is good for bonds. It's a 3D chess game. The currency is just one piece on the board. So, let's zoom out and restore the full picture. What is really happening here in November 2025? We are witnessing the exhaustion of the strong dollar trade. The market has priced in American exceptionalism, the idea that the US economy can grow at 3% forever while the rest of the world stagnates. That narrative is cracking. The yen is the pressure valve. When the US economy cools, that pressure releases. The yen shoots up. The narrative that PM Takaichi is going to bankrupt Japan is a distraction. It's noise. It's a spooky story traders tell each other to justify shorting the yen a little longer. But the fundamentals, the real math, point to a reversion. Fair value is calling. And fair value is a lot lower than 157. So, bosses, what is the takeaway? If you are holding dollars and need yen, maybe you're a Japanese company, or you're planning to buy a house in Tokyo, patience is your friend. The wind is about to change. The sales are coming. If you are a speculator riding the short yen train, be careful. You are picking up pennies in front of a steamroller. The Fed is sharpening its scissors to cut rates, and when they do, the exit door for the yen short trade is going to be very, very small. Don't be a leak. Don't follow the herd right off the cliff. The narrative today is yen weakness forever. The reality tomorrow is the great rebalancing. Morgan Stanley has drawn the line in the sand at 140. The government is watching with urgency. The Fed is getting nervous. The board is set. It's your move. As always, this is Boss Economic World. I analyze the truth, you make the money. If you like this deep dive, smash that like button, subscribe so you don't miss the Q1 reversal, and leave a comment below. Do you think the yen hits 140, or is the dollar unstoppable? I'll see you in the next one.